SOXX ETF, Tech's hidden gem or risky bet? Today, we're diving deep into the iShares Semiconductor ETF, also known as the SOXX. Is it a hidden tech gem that could explode your portfolio, or a risky roller coaster ride you should avoid? We'll crack open the SOXX to see what lies inside, from its high-flying potential to the hidden dangers lurking beneath the surface. By the end of this video, you'll know exactly whether the SOXX ETF deserves a spot in your investment strategy. So buckle up, tech enthusiasts and curious investors, because it's time to chat about the SOXX. Question 1. What is SOXX ETF? The SOXX ETF, also known as the iShares Semiconductor ETF, is an exchange-traded fund, ETF, that tracks the performance of the U.S. semiconductor industry. Here's a breakdown of what that means. Understanding ETFs. An ETF is a basket of securities, typically stocks, that trade on a stock exchange, just like a single stock. SOXX, in this case, holds shares of various companies involved in the design, manufacturing, and distribution of semiconductors. Focus on semiconductors. Semiconductors are tiny electronic chips that form the foundation of modern electronics. They play a crucial role in everything from smartphones and computers to cars and medical devices. The SOXX ETF provides investors with exposure to this critical technology sector. Tracking an index. The SOXX ETF doesn't pick individual stocks. Instead, it aims to mirror the performance of an existing index, in this case, the NYSE Semiconductor Index. This index comprises a specific set of U.S.-listed companies in the semiconductor industry. By tracking the index, the SOXX ETF offers a diversified way to invest in the sector. Benefits of SOXX ETF. Targeted exposure. If you're bullish on the future of semiconductors, the SOXX ETF offers a convenient way to gain exposure to the entire industry with a single investment. Diversification. Owning an ETF provides instant diversification compared to picking individual stocks. SOXX spreads your investment across multiple companies, reducing risk. Lower cost. Typically, ETFs have lower expense ratios compared to actively managed mutual funds. Question 2. How closely does the SOXX ETF track the underlying index, SOXX? The SOXX ETF, or iShares Semiconductor ETF, strives to track the performance of the underlying index, the NYSE Semiconductor Index, SOXX, very closely. However, there isn't always a perfect correlation, and there can be slight deviations for a few reasons. Tracking differences. Expense ratio. The SOXX ETF incurs fees to cover administrative costs, management, and other operational expenses. This expense ratio is deducted from the fund's returns. While minimal, it can cause the SOXX ETF to slightly underperform the SOXX index, which doesn't have such expenses. Tracking methodology. There are different ways ETFs can track an index. Some replicate the index by holding the exact same proportions of each underlying stock. Others might use representative sampling, holding a basket of similar stocks that captures the overall index performance. While both methods aim to mirror the index, slight variations in holdings can lead to minor tracking deviations. Bid-ask spread. When buying or selling shares of the SOXX ETF, investors trade at the bid-ask spread. This is the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask. This spread can cause minor deviations between the ETF's price movement and the underlying index, especially during periods of low liquidity. Generally, the SOXX ETF tracks the SOXX index very closely. The expense ratio and bid-ask spread are typically minimal, and the tracking methodology is designed to minimize deviations. Question 3. What is the weighting methodology used for the SOXX ETF? The SOXX ETF, or iShares Semiconductor ETF, tracks a modified market capitalization weighted index, specifically the NYSE Semiconductor Index, SOXX. Here's a breakdown of what that means. Market capitalization weighting. In a market cap weighted index, each company's weight within the index is based on its market capitalization. Market capitalization is calculated by multiplying the current stock price by the total number of outstanding shares. So, companies with a larger market cap, higher stock price, and/or more outstanding shares have a greater weighting in the index. Modification in SOXX. The SOXX index applies a slight modification to the standard market cap weighting. The exact details of this modification aren't publicly available, but it likely involves capping the weight of any single company to prevent overexposure to any one stock within the SOXX ETF. Impact of weighting. This weighting methodology ensures the SOXX ETF reflects the performance of the larger, more established companies in the semiconductor industry more heavily. Smaller, emerging companies will have a proportionally smaller influence on the overall performance of the ETF. Benefits of modified weighting. This approach offers some stability by reducing reliance on the performance of a single company. The focus on larger, more liquid companies can also improve the tradability of the SOXX ETF itself. Alternatives to market cap weighting. It's important to note that market cap weighting isn't the only approach. Some ETFs use equal weighting, where each company in the index receives the same weight regardless of size. This can be beneficial for capturing the growth potential of smaller companies in the sector. Question 4. Does the SOXX ETF hold all the constituents of the SOXX index, or does it exclude any? The SOXX ETF, or iShares Semiconductor ETF, likely does not hold all the constituents of the SOXX index. It most likely excludes some smaller companies due to a specific weighting methodology employed by the SOXX index itself. Here's a breakdown of why SOXX might not hold all SOXX constituents. Market cap weighting with capping. The SOXX index uses a modified market cap weighting approach. In a standard market cap weighted index, companies with a larger market capitalization, stock price x outstanding shares, have a greater influence on the index. However, the SOXX index incorporates weighting caps. This means there's a limit to how much any single company can influence the overall index. Impact on SOXX holdings. Due to these caps, the SOXX ETF likely wouldn't hold all the companies in the SOXX index. Smaller companies with lower market caps would likely be excluded from the ETF holdings to prevent any single company from exceeding the capping limit within the SOXX itself. Benefits of capping. Weighting caps help to diversify the SOXX ETF and reduce reliance on the performance of a single company. This can lead to greater stability for the ETF. Question 5. How concentrated is the SOXX ETF in terms of its top holdings? The SOXX ETF, or iShares Semiconductor ETF, exhibits a relatively high concentration in its top holdings. This means a smaller number of companies within the ETF account for a significant portion of its overall value. Here's a deeper look into this concentration. Tracking a weighted index. The SOXX ETF tracks the NYSE Semiconductor Index, SOXX, which uses a modified market capitalization weighting methodology. In such an approach, companies with larger market capitalizations, stock price x outstanding shares, have a greater weighting within the index. Impact on SOXX holdings. Due to this weighting, the SOXX ETF tends to hold a larger portion of its assets in the biggest and most established companies in the semiconductor industry. These companies will have a more significant influence on the overall performance of the ETF compared to smaller, less established ones. Concentration levels. Several sources indicate that the SOXX ETF has around 60% of its assets invested in its top 10 holdings. This signifies a fairly high level of concentration compared to broader market ETFs. Implications of concentration. Potential for higher returns. If the leading semiconductor companies outperform the broader market, the SOXX ETF could benefit significantly due to its concentrated holdings. Increased volatility. The ETF's performance becomes more reliant on the performance of a few companies. If any of these top holdings experience a downturn, the impact on the SOXX ETF could be substantial. Reduced diversification. Compared to an ETF holding hundreds or even thousands of stocks, the SOXX ETF offers less diversification. This can increase risk, as a downturn in the semiconductor industry could significantly impact the ETF's value. Question 6. Are there any sector biases within the SOXX ETF compared to the broader market? Yes, the SOXX ETF exhibits significant sector bias compared to the broader market due to its focus on the semiconductor industry. Here's a breakdown of this bias. Narrow industry focus. The SOXX ETF exclusively invests in companies within the semiconductor industry. This means it lacks diversification across other sectors that make up the broader market, like financials, healthcare, or consumer staples. Comparison to broad market indexes. Broad market indexes, like the SP 500 or FTSE All-World, aim to represent the overall stock market performance by holding companies across various sectors. These indexes typically allocate holdings proportionally to each sector's weight within the economy. For instance, the technology sector might make up around 20% of the SP 500, so 20% of the index holdings would be tech companies. SOXX ETF's bias. In contrast, the SOXX ETF dedicates 100% of its holdings to the semiconductor industry. This creates a significant bias compared to the broader market, where semiconductors represent just a portion of the overall economy. Implications of sector bias. Potential for outperformance. If the semiconductor industry experiences a boom, the SOXX ETF could significantly outperform the broader market due to its concentrated holdings. Increased volatility. The ETF's performance becomes heavily tied to the fortunes of the semiconductor sector. If the industry slumps, the SOXX ETF could experience deeper losses than the broader market. Limited diversification. The lack of diversification across sectors increases the overall risk of the SOXX ETF. A downturn in semiconductors could significantly impact the ETF's value, whereas a broad market index might be able to weather such a storm better due to its diversification. Benefits of considering sector biases. Understanding the sector bias of the SOXX ETF helps investors make informed decisions about aligning their portfolio with their risk tolerance and investment goals. Investors seeking broader market exposure with less sector concentration might consider ETFs that track broader indexes or those focused on multiple sectors. Question 7. How has the SOXX ETF performed during different market cycles? The SOXX ETF, due to its concentrated holdings in the semiconductor industry, tends to exhibit distinct performance characteristics during different market cycles. Here's a breakdown of how it might perform. Bull market. Potential for outperformance. During periods of economic expansion and rising stock prices, the semiconductor industry can often experience strong growth. This is because semiconductors are a crucial component of many technologies, and rising demand for electronics, computers, and other tech products can drive up demand for chips. As a result, the SOXX ETF, with its concentrated exposure to this sector, could outperform the broader market that might see more moderate growth across various sectors. Bear market. Increased vulnerability. When the overall market declines due to economic downturns or recessions, the semiconductor industry can be particularly vulnerable. Businesses tend to cut back on discretionary spending during recessions, which can lead to decreased demand for electronics and other chip-dependent products. The SOXX ETF's concentration in this sector amplifies these downturns. It could experience steeper losses compared to a broader market ETF that benefits from diversification across sectors that might hold up better during economic slowdowns. Economic uncertainty. Heightened volatility. Periods of economic uncertainty can lead to increased volatility in the stock market. This is especially true for cyclical sectors like semiconductors. The SOXX ETF's concentrated holdings magnify this volatility. Its price could fluctuate more significantly than the broader market in response to economic news and investor sentiment. Growth versus value cycles. Growth versus value. The market can sometimes favor growth stocks over value stocks, or vice versa. Semiconductor companies typically fall into the growth category, as they are often at the forefront of technological innovation. During growth cycles, the SOXX ETF could outperform if these companies experience strong stock price appreciation. Conversely, during value cycles, the ETF might underperform if investors favor more established companies in defensive sectors. Long-term versus short-term. Long-term potential. Over extended periods, the semiconductor industry has historically demonstrated significant growth due to the ever-increasing role of technology in our lives. The SOXX ETF, by providing exposure to this sector, could offer long-term capital appreciation potential for investors with a long-term investment horizon. However, short-term performance can be more volatile, and the ETF's price movements might not always reflect the long-term growth trajectory of the industry. Question 8. What are the correlations of the SOXX ETF with other asset classes? The SOXX ETF, due to its focus on the semiconductor industry, exhibits varying correlations with other asset classes. Here's a breakdown of these correlations. Positive correlations. Technology sector. The SOXX ETF will likely have a strong positive correlation with the technology sector of the broader market. This is because the performance of semiconductor companies is often tied to the overall health of the technology industry. When the technology sector thrives, demand for chips typically rises, benefiting companies within the SOXX ETF. Neutral correlations. Bond market. The correlation between the SOXX ETF and the bond market can be neutral or slightly negative. Semiconductor companies are not directly tied to interest rates, which significantly influence the bond market. However, during economic slowdowns, investors might flock to bonds as a safe haven, potentially causing the SOXX ETF to experience a decline if the economic slowdown impacts the technology sector. Negative correlations. Commodities. The correlation between the SOXX ETF and commodities like oil can be slightly negative. A booming commodity market might indicate concerns about inflation or economic overheating, potentially leading to rising interest rates. As mentioned earlier, higher interest rates could negatively impact the technology sector, and consequently, the SOXX ETF. Factors affecting correlations. These correlations are not always fixed and can fluctuate depending on several factors. Economic conditions. The overall health of the economy can influence correlations. During strong economic periods, correlations between asset classes might tighten. Conversely, during recessions, correlations can weaken as different asset classes react independently to economic stress. Investor sentiment. Investor risk appetite can also play a role. If investors are risk-averse, they might flock to safe haven assets like bonds, even if the economic slowdown doesn't directly impact the semiconductor industry.